Hello traders, and welcome back to another episode of Pipeline Trading. Without the ability to correctly identify valid high-quality order blocks, trading can become extremely risky and lead to significant losses. Order blocks, often overlooked by retail traders, are a cornerstone of smart money concepts and play a vital role in executing well-informed trades. The challenge is that many traders struggle to separate strong order blocks from weak ones, which exposes their positions to unnecessary risk. In today's advanced pipeline trading episode, we'll explore different types of candlestick order blocks, trading strategies, and the price action behavior linked to these zones. We'll also break down the essential rules and criteria that transform an ordinary order block into a high probability trade. So if you're ready to sharpen your edge, make sure to like this video, subscribe to Pipeline Trading. Let's get started. Welcome back, traders. Let's begin with the definition of an order block. In a bearish setup, an order block refers to the last bullish candle before a sharp downward move that produces a valid break of structure. In a bullish setup, it's the last bearish candle before a strong rally that creates a bullish break of structure. The psychology behind these zones is straightforward. They represent areas where institutional players enter the market with large positions. These zones act as manipulation points, just before a significant move. When price returns to them, they often serve as high probability areas for reversals or continuations. Now, how do we identify valid order blocks? In a bullish market, the valid order block is the last bearish candle before the sharp rally, typically sweeping the low of the previous candle. In a bearish market, it's the last bullish candle before price drives lower, often sweeping the previous high. But not all order blocks are created equal. At Pipeline Trading, we use 4 rules to filter strong setups. Rule 1. Price must sweep liquidity from the previous candle. Rule 2. The move away must create imbalance or inefficiency. Rule 3. The block must remain unmitigated. Once price fully retests it, it loses significance. Rule 4. It must produce a break of structure or change of character in the market. Yes. Let's look at some examples. Imagine a red candle forms just before 3 strong bullish candles. If that red candle sweeps liquidity, creates imbalance, and remains unmitigated, it qualifies as a valid order block. On the other hand, if a block is mitigated immediately or fails to create imbalance, it's not valid, and we move on to the next candle. This same logic applies in bearish markets, and it works across all timeframes, whether you're scalping on lower charts or trading higher timeframes. Now let's test this on a live chart. Here we have the euro-dollar on the 15-minute time frame. Price is trending higher, and we see a bullish break of structure. From here, we look for the order block linked to that move. The last bearish candle before the rally looks like a candidate, but when highlighted, it's clear the wick mitigates it. That makes it invalid. Looking higher, we find another bearish candle that sweeps liquidity and leaves imbalance. This one becomes the valid order. Repeating this process across the chart shows how important it is to filter carefully. Price often sweeps liquidity, known as inducement, before tapping into the true block. That's why patience is essential in the pipeline trading approach. When price returns to the valid block, it reverses and pushes higher, creating a clean long opportunity. Later, a change of character forms as price breaks internal structure, and once inducement is cleared, price taps into the next valid block, giving us another high probability setup. Now let's talk about entry models. At Pipeline Trading, we use 4 main entry types. The first is wick entry. Place your order on the wick, with a stop just beyond it. This has a high chance of entry, but requires a wider stop. The second is body entry. Place your order on the candle body, with a stop beyond the wick. This tightens the stop, improving risk to reward, but you may miss the trade if only the wick is tapped. The third is midpoint entry. Enter at the midpoint of the order block, with a stop beyond the high or low. This often provides the best balance between precision and risk, and is favored by many professionals. The fourth is aggressive entry. Place your stop inside the order block itself. This offers the tightest risk, but is the riskiest, as price may fully test the zone before reversing. And that wraps up today's session. We've covered what order blocks are, the psychology behind them, the rules to filter valid setups, how to test them on live charts, and the 4 main entry models. With these tools, You can now incorporate order blocks into your own trading plan with confidence. Thank you for watching Pipeline Trading. If you found this video helpful, subscribe and turn on notifications so you never miss an update. Leave your comments below and let me know what topics you'd like me to cover next. It's been Pipeline Trading, and we'll see you in the next episode. Happy trading. God bless.